There are many insights that can be inferred from different ratios. The beauty of ratios is that they can be decomposed to evaluate the drivers of a particular ratio. The decomposition of ROE, known as the DuPont system of analysis, is one famous example. To understand what drives a company's ROE, we can express the ROE as the product of the ROA and financial leverage. In other words, ROE is a function of a company's ROA and its use of financial leverage. This means that a company can improve its ROE by improving its ROA and/or making more effective use of leverage. For example, if a company has no liabilities, its leverage ratio would equal 1.0. The ROE would be exactly equal to ROA. As a company takes on liabilities, its leverage increases. As long as a company is able to borrow at a rate lower than the marginal rate it can earn by investing the borrowed money, the company is making an effective use of leverage. The ROE would increase as leverage increases. If a company's borrowing cost exceeds that marginal rate, the ROE would decline as leverage increases. This is because the effect of borrowing would depress the ROA. The ROA can be further decomposed into the net profit margin and total asset turnover. The net profit margin is an indicator of profitability, how much income a company derives per dollar of sales. The asset turnover ratio is an indicator of efficiency, how much revenue a company generates per dollar of assets. This decomposition illustrates that a company's ROE is a function of its net profit margin, its efficiency, and its leverage. We can further decompose the net profit margin as shown. This decomposition expresses a company's ROE as a function of its tax rate, interest burden, operating profitability, efficiency, and leverage. This five-way decomposition is the one found in financial databases such as Bloomberg. The tax burden measures the effect of taxes on ROE. Essentially, it reflects 1 minus the average tax rate, or how much of a company's pre-tax profits it gets to keep. So a 30% average tax rate would yield a factor of 0.7. A higher value for the tax burden implies that the company can keep a higher percentage of its pre-tax profits, indicating a lower tax rate. The interest burden captures the effect of interest on ROE. Higher borrowing cost has the effect of lowering this ratio, thereby reducing the ROE. The EBIT margin measures the effect of operating profitability on the ROE. Firms which are more operationally profitable have a higher EBIT margin. Let's go through an example to see how we can use this framework to determine what factors are driving a company's ROE. Sunex Corp's ROE fell sharply from 32.5% in 2014 to 13.2% in 2015. The income statement and balance sheet are given in the tables to the right. Use the 5-part DuPont analysis to explain the critical factors that account for the decline in ROE. Pause the video now to work out your answer. You may want to work out the 5 ratios for 2014 and 2015 and compare between the two periods. And we're back. Verify if you've got all the ratios correct. They should be quite straightforward other than calculating the average values in the balance sheet. You can use the average of the beginning and ending values for each year. For example, the average total assets in 2015 is the sum of the beginning and ending values divided by 2. So what can we infer from the ratios between the 2 years? We notice that the ratios between the 2 years are largely the same, other than the EBIT margin and leverage ratios, which have significant declines. The drop in EBIT margin is more pronounced. This suggests that the profits from operations have eroded significantly. This is confirmed when we look at the income statement. That sales has declined while costs have gone up over the year. The decline in financial leverage suggests that the capital structure of the company has shifted towards that of having less debt. While this lowers the risk to the company, it also suggests that the leverage effect is reduced. Moving forward, shareholders may have to accept a lower rate of return.
You're watching an excerpt from our comprehensive animation library. For more videos like these, head on down to prepnuggets.com. At Prep Nuggets, let us do the hard work for you.